From raw material purchases by Berkshire subsidiaries, are you seeing signs of inflation beginning to increase?
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. The costs are just up.
Because the government, Wall Street, the Federal Reserve has a vested interest in the public not understanding how bad inflation is. In fact, one of the ways the Fed's been able to justify creating more inflation is because they claimed we didn't have enough of it.
It's an economy really, it's red hot.
There is a point where it's dangerous. My attitude with something as big and dangerous is to stay a long way away from it.
We're still not completely out of the pandemic. There's uncertainty that comes from that, and that uncertainty is going to affect economic activity, and we're going to have to deal with that in some way.
At the end, if you print too much, you end up in something like Venezuela.
This is Warren Buffett, one of the most successful investors out there. After taking over Berkshire Hathaway in 1965, he has averaged a mind-blowing average annual return of 20%, basically doubling the average return of the S&P 500, and that's including its dividends. So just to put that in perspective, over all this time from 1965 to 2020, the S&P 500 would have gave you a 23,454% return. Sounds pretty nice, right? Well, you know what the return Warren Buffett has made over that time? 2.8 million%. So yeah, he's pretty good at what he does. Whether you agree or disagree on his investing strategies, you gotta hand it to him. The man knows what he's talking about. But as we all know, we're dealing with some pretty difficult market conditions at the start of 2022. For one, we're dealing with a massively overvalued stock market. This is what I like to call the Buffett indicator. It's just the composite market value to GDP. This is the historical trend line right here. And as you can see, we are way overextended above the trend line. And this isn't exactly a gradual increase either. So I don't know how you are taking that, but to me, it looks like the market is a bit overvalued at this point. Then there's the S&P 500 PE ratio. You can see where the internet bubble popped, you can see where the 2008 financial crisis ended up, but look where the historical average is, way down here. Look how extended we are right now. Now look, the market could easily break through this chart and keep skyrocketing up, creating new record highs. Nobody knows what the market is gonna do. I'm not a professional financial advisor, but I do like to analyze the information that is given to me. Then there's the whole coronavirus pandemic thing, and different variants coming from every single corner. Hey. Which basically gives the government the go-ahead to print infinite amounts of money, increasing the inflation rate to a 39-year high, rising 7% in 2021, compared to the average 2%, which is a pretty good indicator that the Fed is gonna slowly start raising interest rates. And we all know what happens to the stock market when the interest rates start rising. So with all this chaos, what is Warren Buffett buying? What stocks is he staying away from? To know the answer, we have to take a deeper dive into trading around inflation.
It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember. You can never do one thing. You always have to say, and then what?
That interview was in May 2021, right before the major increase in inflation. And after hearing that interview, you can kind of tell Warren Buffett predicted this whole inflation scenario occurring. If you have 0% interest rates and you have a huge amount of money printing, of course there's gonna be a rise in inflation. In order to understand inflation, we have to understand investing. You need to be thinking of investing like this. You are essentially taking buying power and investing it into something to potentially get more buying power. So say if we had enough capital to buy 100 boxes of Cheez-Its. Not a sponsor, but hey, if you work for Cheez-Its, hit me up. So you have 100 boxes of Cheez-Its right now, but you want to invest to be able to buy more Cheez-Its in the future. So you invest. After 2 years of investing, you got a 20% return on your Cheez-Its. So now you can buy 120 boxes of Cheez-Its. But you know what happens if there's a 10% annual inflation? Not good things. Even though your investment over 2 years gave you a 20% return, there was still a 10% inflation rate, which over 2 years would equal 20%. So even though you made a 20% return, there's 20% inflation, which means your money is worth 20% less, making your quote-unquote investment not really an investment at all, and you're still left with the same amount of money you had before, meaning basically you wasted 2 years of buying power, which could have been used on some better investments that would have actually made use of your buying power. So investing during high inflation is a real bad experience, because if your investments are increasing, technically you could still be losing money. Almost as if you were walking up an escalator that was going down. You wouldn't be getting anywhere. But how are we supposed to invest when inflation is on the rise? Well, if we head back all the way to 1982, Warren Buffett had to deal with a similar issue. Inflation was just cooling down from a 15% inflation rate, so he had to invest during that struggling time as well. What did he invest in? Well, luckily, Berkshire Hathaway is a public company, so we can see the exact message he sent to all of his shareholders back in 1982. He said this exact message: such favored businesses must have two characteristics. 1. An ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. 2. An ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. So, cool. We can read the message he sent to all of his shareholders. But what does the message actually mean? Well, first let's take a deeper look into number 1. In number 1, he's simply saying he's interested in companies that can increase their prices without any consequences, which that in itself is a very powerful tool against inflation. But you would think if companies increase their prices, the consumer would just head to a different company. So what companies can just increase their prices at any moment and get away with it? Well, that blue text bubble is a hint, because one of those companies is Apple. Whether you're on Team Blue Bubble or Team Green Bubble, Apple has pretty much been getting away with legal highway robbery. I mean, iPhones are basically selling for the prices of cars these days. If you look at this chart, you can see the average iPhone selling price in 2012 was around $600. In 2018, it raised all the way to $800, and that's just 2018. Think of what it's at now. And you know why they increase prices like this? Because they can. They can increase their prices all they want, just because of how loyal their fan base is. The average user, if they have an Apple phone right now, they're likely to get another Apple phone in the future. Now, of course, Apple can't just increase their latest iPhone price by $1,000 randomly. They have to do it in little increments, to go basically unnoticed and have the consumer not care too much when prices do increase. Can you think of any other companies like this? Have you ever met a die-hard Coke fan? If you even have a Pepsi can anywhere in the room, they freak out, let alone want to drink it. Well, Coke, the company, has definitely realized this. They've noticed if they increase their prices, if you drink Coke, you're only drinking Coke. And you know what companies Warren Buffett is holding right now? Apple and Coke. And pretty big position sizes too. One of the biggest strategies of investing during high inflation is investing in companies that have a strong competitive advantage. They can increase prices higher than the competition and still get consumers picking them. So we went over number 1, but what does number 2 mean? In this message, he's basically saying he wants companies that can generate a lot more cash without needing to spend a lot of cash. If you can't pass on the cost to your consumers like Apple and Coke do, you're gonna have to cut the cost yourself. So, for instance, if I say, I don't know, Kia wants to sell more cars, they're gonna have to make more factories and hire more employees to make more cars. But whereas, say, a digital company like Google or Facebook, they can just increase their frequency of their ads at any time, making more money with no additional costs. So when you're scrolling through Instagram, instead of seeing 2 ads, you're seeing 3. And the important thing about this is they can do this extremely easily and, more importantly, for cheap. They don't have to make more factories. They don't have to hire more employees. They just simply type in some code and they're now making more money. In times of inflation, you should be looking for companies with big competitive advantages and companies that can scale up at a low cost quickly. If you can find those, you'll do just fine. So that's one strategy. But maybe you're not the type to look for companies like this. Well, Buffett has a different strategy for you.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
I really love that interview. He's saying there that no matter rain, sleet, or snow, just keep investing into index funds. Don't read headlines, don't listen to the news, just stay on your regular schedule of investing into an index fund. If you invest normally in a scheduled manner into an index fund, you're gonna get the average mean of the market. So just because the market is in a downtrend now and looks hideous, if we zoom out, it just looks like a normal dip. The nature of index funds are beautiful. You're basically acknowledging, hey, I don't know enough about picking companies, and I don't know enough about picking them at good times. But what I do know is there's a 10% annual return with index funds. And there is absolutely no problem with trading like that. It's extremely hard to beat the returns of an index fund. So if you're an active investor, be patient. Don't force anything, wait for your time, and get in when you can be confident. If you're a long-term trader or a passive trader, just continue as if nothing happened. But Buffett has one more piece of advice, and it's a pretty important one too.
But given the fact that we're dealing with fairly high levels of inflation in India, what would your advice be to people who are investing? What should they change? What should they do?
Yeah, well, inflation, Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best protection, the best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate. And the best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency.
In this clip, he's more or less saying, investing in a market that is highly inflated is a pretty shitty time, and it makes it a lot harder to make money from investing. So he makes the point of investing into yourself during this time. So whatever you're doing right now, get better at it. This way you can try to increase your buying power, so when the market is back to normal, you'll be in a good place to take advantage of it. Warren Buffett doesn't buy overvalued stocks. He just continues to accumulate cash and waits patiently. Actually, Berkshire Hathaway's cash has gone from 84.4 billion in 2016 to 149.2 billion in 2021. So I get it, it's no fun. But Charlie Munger said it best. You don't make money when you buy, and you don't make money when you sell. You make money when you wait. So it's a really annoying time right now. There's no getting around it. But what separates a great trader from a bad trader is a bad trader loses money during bad markets. Then when the time comes when the market is back to normal, they have no buying power. A great trader can stay alive during the bad markets so they can invest heavily when the markets are back to normal. It's pretty simple, I know, but it's an important lesson to embed in your brain. So what do you think the markets are gonna do? Do you think the bear market that we've been seeing for the past couple weeks is the end? Or do you think it's gonna keep on dropping? Let me know in the comments. I really want to know what you guys think. Do you want to know what hedge funds or even billionaires like the man himself are investing in? Watch this video. I tell you exactly how to see any hedge fund's portfolio in 16 seconds. Like, literally, the video is 16 seconds long. Take 16 seconds out of your day and it might just give you the information needed to make thousands of dollars. Sounds like a pretty good deal to me. Thanks for watching, and I'll see you guys next time.